Ladies and gentlemen, please welcome our first session to the stage.
Good morning. Good morning. Thank you all for joining us. We appreciate it. We got a lovely day to spend with all of you, and terrific to start today's conversations with my old friend Chairman Atkins. We've known each other for over 20 years.
That's
I was
right.
trying to think about it the other day when I was a young Senate banking staffer, and you were on your first tour at the SEC at that point as commissioner. And I think I speak for a lot of people in this room when I say we are very happy that you were in that spot.
Thank you. All right. Thank you. All right.
This time last year, there was a lot of doom and gloom. As an industry, we were fighting 25 plus rules from Gary Gensler. We sued the SEC 3 times. Fortunately, we won our 3 lawsuits, but it was a very different time, and we are happy to turn the page and move forward under your leadership. So thank you for agreeing to serve again. It seemed like you were just starting to get momentum in the past couple of weeks with a number of no action letters, and then the government shutdown happens. What does the shutdown mean for you and for the SEC's actions today?
Well, we're still within limits. We're still obviously functioning, and so there are restrictions on what we can and can't do, and especially for staff. But there are a number of us who are what they call exempted personnel, and so we're able to I can still come and do things like this with you all. So we're not slowing down at all. We're still, people are still thinking about what needs to be done and planning and all of that. So there are a lot of things on the agenda, basically in every one of the divisions of the SEC, and still trying to bring on people on board. It's sacrifice to go in and do public service, and especially with financial services folks, because securities that are waiting to be vested and all of that, and so it's tough for them to do that for their families. So, but notwithstanding that, we're bringing in great people, and I really have a lot of confidence in going forward.
So, coming back to the SEC, this time as chair, it's been a while since you were there as commissioner. Upon your reentry, what has been the biggest change for you in terms of how you see the agency, what the agency's like today from when you left it?
Well, it's a lot bigger, let's just say that. When I left this is now my 3rd time at the SEC. So I started there in 1990. I was working for a law firm up here in New York, and when I got engaged, my wife said, "I'm not moving to New York, you need to find a new job." And so anyway, the compromise was Washington, and my resume wound up with the chairman of the SEC who asked me to come on board. So so was there for 4 years, and then came out into the private sector, then went back as commissioner from 2002 to 2008, and then now obviously the 3rd time. 3rd time's the charm. But when I left in 2008, there were about 3,000 some odd employees at the SEC. On Inauguration Day earlier this year, it was 5,100. And now we're about at 4,100. So there were there was some retirement programs and whatnot that kicked in with the new administration. So about 15% of the employees took those voluntary retirements, and we're going through now another round of that. And so it's so a lot of the old hands are leaving, but that leaves room for others to rise up who are, I think, very very good and competent. So that's one aspect. The budget is a lot bigger than before. It's now a $2 billion agency. It was about half that much back in 2008, and so that's another aspect. And so the other thing, the real big change though, is I think all the potential that we have now to really make lasting changes in the marketplace. So with respect to regulation, with respect to innovation, and that's what I like to say is that we're the Securities and Innovation Commission now, which is a big change from what was here earlier part of the year and the previous 4 years.
From a markets perspective, certainly the growth of private markets post Dodd-Frank, post your last stint at the SEC has probably been the biggest change. How do you think about the role of private markets today from your seat?
Well, private markets are really important. I think with respect to private credit, which I've been in Europe here twice now in the last 3 or so weeks, trying to argue on behalf of our private markets, because of course they're viewed with a bit of skepticism by Europeans, where their financial system is more centered around traditional banking and that sort of thing. But thank goodness that we have private markets here, because with the rules around banks and capital and whatnot, they can't really lend in these markets anymore. It doesn't pay, and plus the examiners give them this the cross-eyed look if they dare do that. So luckily, the private markets have stepped in and to good effect. But we need to, I think, really focus anew on the public side, especially on equity. That I like to say we need to make IPOs great again, make it cool to be a public company. And there are a lot of impediments now that people just don't want the brain damage of being a public company and the threats. So basically it comes down to litigation, comes down to the cost of regulation, and then finally the gamesmanship and weaponization of corporate governance and shareholder proposals and that sort of thing. So you put all that together, and it's pretty comfortable to stay as a private company. And so, but with all the interest now from even the retail side to be in the private space, I think it's even more important to focus on how do we bring the number of public companies back up. We have half the number that we had 30 years ago, and so we need to focus on that to make a good ecosystem, as you all know better than most people.
Yeah, I saw an announcement pre-shutdown where you gave companies the option to have arbitration in their governance document as preferred method of dispute resolution. That was something that the Gensler SEC did not allow. You also tweeted about an issue that's important for a lot of people in this room, or maybe the president tweeted, you followed up with a statement around, in an op-ed, on potentially changing the quarterly reporting cycle. Would like to hear your thoughts on how you balance the costs and burdens on issuers versus the need for information and data by investors. What's that balance and calculation like?
Yeah, well, I think, I, as a believer in the free markets, I think the markets have an amazing ability to affect behavior by people that the markets invest in. And so ultimately, a lot of this comes down to what is it that the markets demand. And so there have been studies and discussion for decades now. Do the Qs add to a short-term did in his first term, and so we've been thinking about we're taking a look at the various types of issuers that are out there as far as their categories. So it goes to large accelerated filers down to emerging companies and things like that. But we were thinking about looking at where semi-annual reporting would be better, and so good for the president to issue his message there. And so we are looking at that, and we will come out with a proposal to allow for semi-annual reporting. And so we'll see what the comments are and go through that whole process. But some people, you see both sides, and there have been both sides argued now for a while, but in the press where some people say, this will be terrible, less transparency and whatnot, and others say it'll be good. So we'll see where the comments come. But if you look at historically, the United States had annual reporting until 1955, went to quarterly and went to semi-annual after that, then went to quarterly reporting in 1970. So it's been 55 years of quarterly reporting. In the United Kingdom, now they have a little bit different market than we do, but they went from Qs to semi-annual back in 2014, and so they allow some companies still report on quarterly cadence and whatnot. So I think there's a lot of good data out there, I would argue, that we can look at, and that hasn't caused the UK markets to crash or anything. And so I think we can definitely learn. I think certainly smaller companies, can probably, semi-annual is better suited for many of them, and maybe others not. But I think the market will be able to decide that, and we'll take comments and see where it goes.
Do you have a sense of timing for that process and when you might be in a position to put out a rule proposal?
Well, we have a shutdown now, so anyway, all that's
true.
out. I don't really know. We'll see, but maybe towards the end of the year or beginning of next year. But anyway, I think these sorts of issues are on a fast track. We have a new head of corporation finance now, who's a great guy, Jim Maloney, who has a lot of experience and also has SEC background. He was head of the mergers and acquisitions group in corporation finance, so he knows how to get the trains moving and get things out the door.
So I want to go back to a comment you made on private markets and private credit in particular. This has been a large growing asset class, important to funding, financing to small and medium-sized businesses. Oftentimes, the private credit model will be conflated with the bank model because there is lending, but very different model in terms of how funds are structured, liquidity risk, things like that. You sometimes hear bank regulators saying, look, we should have bank-like regulation on private credit. Is that a topic that you talk to your peers about, either in the U.S. at the bank regulatory agencies or internationally?
Oh yeah, no, that topic comes up all the time because again, abroad they have a completely different system. They don't have the private markets to a large extent. And I used to be, when I was with a law firm, was posted for 3 years to the Paris office. This is in the late 80s in the run-up to the Big Bang there in 92. But I remember one client of mine who had started one of the first German venture capital funds, and that was successful back then. But it was just his description of the way the German market works with respect to the banks being the primary movers there with the so-called Mittelstand, the middle tier of companies, below the biggest ones. It was much more of a burdened type of economy because of the bank regulation. So we are much more flexible, obviously, and so thank goodness that's great for the economy. And so we, at least in this administration's view, from all of us in the financial services regulatory sphere, we don't view the private markets as being systemically important, to bring down the banking system. But you have blips here and there of where if the banks don't understand where the exposures are with their clients, so like long-term capital situation, Archegos, and those sorts of things. It's important, obviously, to know your customer and to have a finger on that. But so I view the private markets as very important, and unlike the banking sector, you don't have the short-term, assets, that can flee at any time, and they're trying to obviously transform things more into long-term lending. So that exposes them in that respect. On the private side, it's a lot different. The leverage is lower, of course, and it's much more of an immediate relationship. So I think all of those things kind of speak well for the private markets.
Another topic that has gotten a lot of interest lately is the idea of expanding access to alternatives to a broader investor base. And there are three different ways that we think about this at MFA. One is potential changes to the accredited investor definition. Two is changes to registered fund products that create more flexibility for alternatives. And then third is the president's recent executive order expanding 401ks. So let's take each of those in turn. So starting with potential changes to the accredited investor definition, this is something you've seen legislation offered by Republicans in Congress already. I think you've made some general comments on it. What's your view on how the SEC should think about the accredited investor standard?
Yeah, well, so, it's a blunt tool, I guess, is the best way to put it. It doesn't make a lot of sense, frankly, and I still remember back when I was a commissioner, at the time, Chris Cox was chairman, and so, we had a proposal out to change the whole definition and the measurement there. And so I remember some of the comment letters came in like, why is it that today I will be able to invest in a hedge fund or whatever, whereas tomorrow when you change it, I will no longer be, and, why can't I do what I want to? Keep your hands out of my wallet and, let me do what I want. So, so that's a very valid, aspect to it. So, I think there are other ways that one could think about it. There are other ways to indicate, sophistication or whatever, somebody who's wants to invest in various products. And so people have suggested over the years, why not have like a driver's license equivalent in this thing. So, so we'll see. I think it needs to be, looked at again after, the last time the SEC looked at it, now it's been a decade or so. So, but anyway, so that will come.
The second area of expansion around changes to some of the rules with respect to registered fund products, we've seen some changes regarding BDCs and share classes. How are you thinking about flexibility in that area?
Yeah, well, so again, there are so many ways that these various products and constructs there, statutory and otherwise, I think are valuable. And it bolsters the private markets. It helps direct capital to smaller companies and supports innovation where the banks are absent. So there again, it's been a long standing emphasis by Congress. It's coming up with the idea of BDCs and whatnot. So we need to take a look at that, and I think that as far as the rules that govern them and the type of person that could invest in them and how that would be done. So we will take a look at that. But I think those sorts of things, as far as various funds go, are again very important, and to democratize it, broaden the scope of people who can invest in it with guardrails around, valuation, liquidity, where in the capital stack they fall, that sort of thing, I think is really important. Side letters, sort of the most favored nation status for, people who get in if they're not, on the more sophisticated level.
Yeah, the president's executive order expanding 401ks has been something that we have been focused on, as have a lot of people in the industry. This was tried before in the first Trump administration. There was an effort to expand 401ks. It was potentially reversed in the Biden administration. The president seems very intent on pushing forward in this area. Talk a bit about your role in this process, how you work at the Department of Labor, how the administration as a whole views this idea of expanding alternatives to 401k participants.
Yeah. Well, I think, again, there's a lot of interest on both sides. On the investor side, for people to have exposure to private markets, as well as obviously from the production side, the product side, from Wall Street and whatnot, to sell into that chain. So, so anyway, so there's interest on both sides, and so I think the president's exactly right to ask us to look into this. So the Department of Labor, of course, has oversight over ERISA-related products and 401ks, and we over the rest of the markets and IRAs and that kind of thing. So we need to, to work together. And so I've already met with the Secretary of Labor and with the Deputy Secretary of Labor. So we will be working together and hopefully having, take a lot of input, commentary from around the country and maybe do a roundtable discussion and that sort of thing, and then formulate proposals to go out, in public with. But suffice it to say, we also take it seriously. We don't want to have, our grandmothers or whatever invest in a bunch of garbage that, is not going to, be appropriate for that particular type of investor. And so we have to make sure that we have, like I mentioned before, guardrails around it, and that there be fiduciary duty, obviously in an ERISA context. So to have guidelines for how boards of these various funds and plans decide what to get into. But as many people, professional managers for large pension funds or whatnot, have seen, to be absent from the private markets is not, a well-balanced portfolio, and especially now that we have half the number of public companies as we did 30 years ago. And if you look at the weighting of, say, the S&P 500, it looks a lot like 99 and 2000. And so, is that the best allocation of capital? So I think there's a lot to be said about this, but we'll be judicious about it and just not fling wide the gates, and so to make sure that people are have protection and know what they're getting into.
One of the things you just said about having roundtables and more process before proposing rules is very much appreciated. I think under Chair Gensler, oftentimes he just put things out without consulting, without trying to shape a rule that was practical, and that triggered a lot of the backlash and litigation that he faced. So certainly appreciate your change in process. And one roundtable you had right before the shutdown was around SEC CFTC harmonization. A lot of people in this room are jointly regulated by both. I would just be curious about how you see that collaboration between the agencies playing out.
Well, to me, that was exciting, and that roundtable produced a lot of great ideas and whatnot that we will be able to live off for a while. But it just, as we go forward, especially with digital assets, the one thing that I'm trying to warn people about is we can't have like two fortresses on either side of a no man's land strip, because that no man's land strip right now is littered with the corpses of would-be products that have gotten killed in the crossfire of the two agencies over the years. And just a couple are single stock futures, portfolio margining, and I think what's threatened perhaps in the digital asset arena. So what we have to do is foster harmonization between the two, and so that's why I like to talk, at least in the digital asset side, about a super app. Basically, if you're duly registered, why can't there be mutual recognition of by the two agencies? And there's no reason why we can't. We all have the same laws that we are subject to and trying to regulate around, with overlapping products and that sort of thing. So we should be very well coordinated. And so the good thing is we are now very coordinated, Form PF, which I think concerns most people in this room.
That's on the list, Paul.
Oh, it was? Okay, all right. So I figured. So anyway, so that's an example of how things should work. And so I salute, Caroline Pham and Kristen Johnson, worked with them. That was one of the first things, I guess, when I came in the door that was presented. So anyway, so we want to get that right. That form is very complicated, collects a lot of information that I can say that no one uses, and so I think it can be pared back rather than impose needless.
PF, which had all of the Gensler amendments. You recently, as you noted, extended it again for a year, which gives you and the commission a chance to really look at the form, the data that's collected. And there really does seem to be this data creep that has happened, where it's just more and more, and it keeps getting piled on top without anyone looking at it holistically and saying, wait a minute, like what do we need all this, and who's actually using it? So is that the idea, is to kind of right-size this form and work with the broader agencies?
Yeah, so we have to, I mean, smart regulation, is basically, measure twice and cut once, and then second is to, only ask for what you need and be cognizant of the costs that you're imposing on the marketplace. So I remember back, when Form PF first came out post Dodd-Frank, I was at a conference one time on a panel with the then current chairman, where she said that, I know this is a complicated form, but we'll be able to ask this, and then if it turns out to be too much, we can pare it back. Well, that never happens in government and I said so as a comeback to that at the time, and I think it holds true. But we are intent now to right-size these requests for information. It's not just Form PF, but in a lot of things that are being collected by the government. So CAT, if you follow the whole discussion around the consolidated audit trail, I was just the shock that I had as to how much that costs. So obviously the Fifth Circuit smashed the current funding model of that, and so that was, for me, walking in the door, obviously that was a necessary catalyst for us to take action as soon as possible. That was on my list of to-dos anyway, right. So the court had that timely decision. But we already have driven down the cost, and it's just, there is, on that I could go on. But the biggest amount of data that's being collected and stored under the CAT right now is options quotes. So you have the big options market makers, penny here, penny there, back and forth all day long. All of that stuff is being ingested and then stored, which is crazy because nobody uses that. And that's not a transaction important thing. Right. So anyway, so there are so many aspects of CAT that need to be changed. And so we had a all hands meeting with the CEOs of the various markets, and so basically I told them that I'm not kidding. This is going to have to be right-sized, and it needs to be cut, significantly. So we are out to right-size that, and basically I would, to return to oats and blue sheets is basically what we need, a modernized version of that.
Well, you've certainly have put a good team in place at the SEC. Brian Daly, as head of investment management, is someone that we look forward to working with, particularly on the Form PF project as we move ahead. I want to switch gears to one of your priorities, which is sort of the broad crypto tokenization conversation, where we're starting to see a lot of action on Capitol Hill. We're starting to see the SEC and CFTC move forward. You've had some no-action letters of late. Talk to us about how you envision the discussion of tokenization playing out within the context of our traded public securities market and then a sort of tokenized market. How do the two work together? Is there a risk of market fragmentation? What's your vision for how this works?
Yeah, well, I think, the main thing is that, like I said, with the Securities and Innovation Commission, so, we shouldn't be blocking innovation in the marketplace. We should be embracing it. And then, where we see, potential issues, to be able to, build in protections against, a catastrophe or whatever. But with tokenization, I really see a lot of benefits. And the SEC in the past has never stood athwart, the innovations until here just recently. But if you go back to the 1960s, here in the markets, there was what they call the paperwork crisis, where data processing had not caught up with then, the paper certificates. If you all, maybe I'm the only one who remembers those, but anyway, not too long ago, my mother died, and so being the executor, She had a stack of still paper certificates, which I thought was pretty cool. But it did take a while to get that process through the broker and sold, but that was okay. But anyway, so it reminded me of those old. '60s, and there were so many fails because the whole data processing apparatus couldn't keep up with the clearing and settling and tabulation of all of that. So brokers failed because of all the fails of transactions. They didn't have enough capital, and so the SEC collaborated with the industry and came up with the idea of the Depository Trust and Clearing Corporation, and that was a huge step forward. ETFs were another step forward later in the early 90s with S&P 500, the spiders then, and then under Chairman Levitt, ATSs I thought were a big step forward. And so now we're on the threshold of the distributed ledger technology and blockchain ability to really make huge changes to de-risk the markets, to have, just think we're not T+1, where that was a good, I think, development out of the previous administration. It could have been done a little bit differently, but whatever, it was achieved. But what about T0? And so where you have immediate DVP, RVP of in the clearance and settlement process, where we may have to build in speed bumps to prevent a fat finger problem, but still that potential, stands to have huge savings and huge de-risking in the market, and then potential other benefits for everybody talks about naked shorting and for public companies to know exactly who their shareholders are, because you can basically trace it through the blockchain, and all sorts of other efficiencies and disintermediation in the marketplace, which will, I think, have huge cost savings and boons for the marketplace. So I'm really very bullish about all of this, and I think you marry that with artificial intelligence, and I think the sky's the limit, frankly, on what's potentially achievable in the financial markets.
One of the, so I would say, early concerns in this debate, and it's got a ways to go, and the technology is fascinating, there'll be a lot of innovation, is this idea of what is a security in one market, if you put it on the chain, may no longer be considered a security. That just because the technology's involved, that changes how a product might be regulated. How are you and the team thinking about that as you move ahead?
Well, again, that's another issue. What I really don't want is the two fortresses and battling over having a turf battle. I didn't come to government to deal in turf battles, and so we have to harmonize, our rule books and have it so that I like to refer to a super app, concept where we can have mutual recognition of somebody who's registered in one regime versus elsewhere, and then have functional regulation as to the underlying aspects. So let's look to the true meaning of the transaction and the product rather than necessarily the wrapper. So so that goes for all sorts of markets right now, but we can work all this out, and I'm really looking forward to working with my counterparts at the various agencies. We now have, all of us know each other, well, and have worked with each other over the years, in the various, from Treasury to, the banking regulatory agencies, and now, SEC, CFTC. So we have, I think, an amazing opportunity to get together and, in a can-do spirit, kind of create something that's lasting. And my main concern is to future-proof this against, future potential changes. So what we have to do is get things implemented, get things agreed, and then let the market work, and then it'll, where changes are necessary in the future, that's fine, but we can't go back to, as I said, fortresses separate and then, fighting with each other.
So a big part of the job is looking ahead and trying to figure out where markets are going and how to create the right rules to facilitate that innovation. But another part of your job is unfortunately still cleaning up some of the rules that were passed by your predecessor. So when you came in, you were very quick to stop a number of open rulemakings, rules that had been proposed, hadn't been finalized, you stopped them. One that I wanted to ask you about is there was a recent Fifth Circuit decision on the securities lending and short sale reporting rules together, where the court basically said, SEC, you didn't do cost-benefit analysis. These two rules adopted on the same day. They're interrelated. You should have done it. We remanded the SEC to go back and do that cost-benefit analysis now. Can you talk a bit about the status of that? And then obviously the government shut down, so nothing's happening now. But when the government reopens, how do you think about the Commission's actions moving ahead to address that court decision?
Well, obviously that's recent, and so we will. That was on the list anyway to review. But like these others, we have the climate disclosure rule that's at the 8th Circuit, which is in a similar position, the CAT decision that I mentioned. So we have a number of these things. So I thank the courts for ruling on these issues. I wish the 8th Circuit would rule on the climate one, but we'll be dealing with that. But so the it's all important, and I think this builds up a really good judicial type of track record that is, when we talk about future proofing, these lay down standards that are important for regulatory agencies to follow, and I think they're extremely important. Notice and comment rulemaking under the Administrative Procedure Act, I think, is vital. It's a due process issue that we need to guard seriously. So anyway, so we will be looking at these various things, but you're right, there were a lot of rules that came out, very much interrelated, and it was difficult, I think, for people to meaningfully comment on something where there were a lot of potentials. It's like a matrix there, and how do you put in commentary to all that. And other issues like where that need to be cleaned up, that affects a lot of people in this room, probably the dealer definition. So I think we need rulemaking in that area, because we should not have 100-year plus understanding of what a dealer is to be overturned through litigation and regulation through enforcement. So that is at a stop at the SEC, and we need to do things in a proper way, and that comports with due process.
Yeah, the Gensler regime became very aggressive with enforcements, examinations, this constant searching for like foot faults to try and sort of tag people with fines and penalties. And it was very frustrating for the industry, because oftentimes there was not an understanding of what are you looking for. We've got everything. Yes, there may be someone violates it, but we deal with it, we address it per our policies. That never seemed to be good enough. Like, how are you thinking about this sort of enforcement, compliance regime? Because that was a real challenge under Chair Gensler.
Well, I think there is more than enough to do to fight real fraud, and there is real fraud in the marketplace. And what really disturbs me is, again, the growth with artificial intelligence. I mean, the stories I hear of people getting ripped off through phone calls and emails and all of that. So if the SEC is not out there fighting this sort of thing, then the states can't do it. All this is international and and multi-state oriented. So the federal government has the tools, and we should be doing it. And so there are pump and dump schemes. We've just shut down 3 other. Now it's a total of 5 or 6 now of Cayman. Well, I don't know if they're Cayman Islands, but Chinese affiliated companies where they have these ramp and dump type of schemes, and, on NASDAQ and elsewhere. So we're out to fight that. So real fraud that is stealing money from real people. And so one of my things that I like to point to of, the way not to do things is the whole off-channel communications issue. So here you had where, there's a requirement to keep books and records and all of that, but it varies, the situation varies from broker-dealers to asset managers to credit rating agencies to whatever. We need like a general, common strain, since people are often registered, and then the CFTC had their own thing too in different ways. So, but there, if you see something that's industry-wide, as you start to do a sweep, then you don't just go down the SIFMA cap table or the MFA cap table, ICI and whatnot, and just start hitting one after another and say, can you account for all your documents or whatever? No. Okay, well, what's your revenue? Okay, here it is. Well, then here's your bill. That's what it kind of came down to. And so, ticket writing and fee taking type of exercise, I think, is not the way to do it. It's like a school teacher, where the class is unruly, will wrap the ruler down and say, class, you get an order, sit up straight and feet on the floor and whatnot. We all have to work together. Let's have round tables. We can't tell you how to solve this problem, but by the way, we also, as a regulator, have the exact same problem, and the way that was solved, unfortunately, is just like turning off texting. So that's not necessarily the answer either. So, because you all have to deal with clients. But anyway, out of all of this stuff, there was not one incidence of untoward activity that was identified or actionable by the SEC. But obviously, very hefty fines that were ladled out, and then just the struggle to figure out, now how do we comply with these kind of very vague types of requirements. So anyway, so we will be looking at that also to kind of set that straight as far as a common requirement, and try to make it so that it's easier to do business and to communicate while maintaining books and records that are important with respect to dealing with customers and running a business.
Well, you're now back for your third tour at the SEC. You've mentioned this idea of future-proofing. I don't know if there'll be a fourth tour, but
my wife won't put up with that. So.
But this idea of future-proofing, one of our concerns is now this ping-ponging in regulation. You go from one administration to the next, and you have these significant swings, which makes it very hard for businesses to plan, to spend on the right systems. How do you think about that in terms of making sure that when you leave, your legacy and what you've done is cemented, and that the industry and markets have some stability for what they can expect going forward?
Yeah, so that's hugely important, and we can't have a ping-ponging back and forth. That doesn't do anyone any good, and it makes the U.S. look like more like a banana republic or something. So we've got to get back to like first principles. But that's why good rulings out of courts are extremely important, and then also to have legislation where we can get it. It's really tough in this or any environment to get something through Congress, and it may not come out correctly. You never know. So anyway, but we can, and then if we can get these rules, adopted and promulgated and implemented, early enough so that they're actually, implemented by the industry, then it gets a bit more difficult to overturn them in a significant way, because you have an ongoing process, and it is more difficult to make a cost-benefit analysis to change it. So anyway, so that's what I am intending to do. So we have good people, we have a good court strategy and whatnot to deal with some of the rules that are on the books, but I think we'll be able to handle that. And so you never know what happens, or a black swan could come flying in and hit us in the face and kind of derail the best laid plans. But anyway, we'll be moving forward and looking to achieve what we can.
Well, I would encourage you to please, for you and your team to use us here at MFA, our members, as sources of information and perspective as you're moving ahead on a number of these rulemakings. Again, as I mentioned, I think that's an area where your predecessor fell short, and we had some unfortunate results. But look forward to working with you and your team. We thank you for coming here to be with us today. We know it's the shutdown. You still found your way here to be with us.
How about that?
Thank you.
Right.
You took an Uber. It's a long Uber ride from DC.
Amtrak still works. So
Amtrak
anyway,
still works for now. Although the new trains aren't that great.
Oh, is that right?
Yeah, terrible. Mr. Chairman, thank you very much for joining us.
Thank you all very much. Thank you.
Thanks.
Thanks.